has an attendee in listen-only mode.
Hi everyone, thanks for joining us today. We'll be starting soon at 7:02. And for today, we are going to have a presentation on, Japan's essential growth story, the macro of Japan's market outlook by Maki Kudo from Global Edge Japan. Thanks for joining us today.
Hi everyone. We seem to be having some technical difficulties. Please give us a few moments to sort it out. Thank you.
Good afternoon, everyone, and thank you very much for joining us today. My name is Maki Kudo from Global X Japan, and speaking to you from Tokyo. And it's great pleasure to connect with you all. And I truly appreciate you making the time tonight. And I hope this session provides a clear and a practical overview of Japanese market, and along with several key themes that are shaping investment opportunities ahead. So I'll start. And this is today's agenda, and I'll begin with quick look of the Japan equity market and introduction of our company. And then I will walk you through the current market environment and finally discuss the four themes we will be focusing on today. And okay. Oh, slowly. So Japan remains one of the world's most important equity market. So as of 2025, the Tokyo Stock Exchange is the fifth largest globally and the second largest in Asia behind Shanghai, with a market cap of 7.6 trillion US dollars. So it also holds the second largest spot in the MSCI Equity Index. So the big point here is that Japan is simply too large and too significant to overlook. And now we all know these Japanese plants, and they're everywhere in Singapore, I think, and from electronics, cars, and the consumer products. But if you look at the chart on the right, you'll see how well balanced the topics index actually is. So it's highly diversified across manufacturing, technology, and the consumer sectors. So this broad industrial base has always been one of the Japan's core strengths. And this is a really exciting chart. And after more than 30 years, the Nikkei finally broke its 1989 record. So we've seen the new highs since last year, which shows a huge shift in momentum. The old lost decade story is over, we think. And thanks to structural reforms and better governance, Japan is moving out the stagnation and entering a new phase of real growth. And this page showing the what's the best way to invest in Japan equity. So you have a few options. So first, the individual stocks allow investors to build their own portfolios, but they require a lot of research and carry higher company-specific risk. And the second one is mutual fund on the right side, and it is giving you the professional management, but the less transparent and no intraday liquidity. And ETFs, on the other hand, give you the best of both worlds and broad diversification and a lower cost than mutual funds, and the flexibility to trade anytime during the trading day. So since they follow transparent rule-based indices, so they are the just very practical and easy way to get exposure to the Japanese market. So let me go a little deeper into the ETFs and their key characteristics. So first one is diversification. A single ETF can provide exposure to an entire market and sector or theme, and it's a great way to reduce the risk of rely on just a few individual stocks. And the second one is lower cost. So ETFs generally have lower fees compared with mutual funds. And the third is flexibility. Since ETFs trade like stocks, you can buy and sell them at the market price through the trading date. And fourth, transparency. Most ETFs disclose their holding daily, so you always know exactly what you have. And fifth, accessibility. So ETFs offer straightforward access to a wide range of geographies, sectors, and even other asset classes such as bonds or commodities. So because of these features, ETFs have really become the preferred choice for investors looking to access to the Japanese market. And so with this characteristic in mind, how large is our ETF market today? So this shows global ETF market size. So in global, ETFs have grown rapidly, and the US leads this expansion with a well-developed ETF ecosystem, strong investor participation, and a deep liquidity. Worldwide ETF assets have now reached about 20 trillion US dollars, showing how widely adopted ETFs have become. And now looking at the Japan ETF market, so our ETF market is still catching up to the US, but the growth has been very steady. So we have now nearly 400 ETF listed in Japan, with total asset reaching around 720 billion US dollars. So more and more Japanese investors are now using ETF as a simple and effective tool to build their portfolios. So we expect this upward trend to continue. So now that we've seen the market size, so let's look at what kinds of ETFs are available in Japan. So right now, you can see on the left side, about 90% of the market is still below the indices like Topics or Nikkei. So for many investors, these are still the core of their portfolios. But over the last 10 years, we've seen a variety of the new options from sector-based to thematic ETFs. So I want to highlight thematic ETFs in particular. So these focus on high growth areas like technology, innovation, and the industry of the future. So this is exactly where we, Global X Japan, has built its expertise. So next, I'll briefly introduce our company, and then we'll dive into the Japanese market outlook and today's 4 key themes. So let me tell you about who we are. So Global X Japan was founded in the 2019. We are the partnership between the Global X. It is a US company and a pioneer of innovative ETFs, and the Daiwa Securities Group from Japan. So these group are one of the Japan's top financial groups. So what makes us unique is that we are Japan's only asset manager that specializes entirely in the ETFs. So our mission is very simple: to provide efficient access to growth themes and the strategies that you won't find anywhere else. So since we started on the 2019, we've been working hard to expand our lineup and really help grow the ETF ecosystem in Japan. So today, we Global X Japan offers 64 ETFs covering a wide range of exposures. On the last month, our total AUM reached 5.7 billion US dollars, and it's reflecting steady demand from both retail and institutional investors. So our lineup is grouped into 4 categories. You can see on the left side, and the first, thematic growth. This focuses on the new economy like AI, semiconductors, and the robotics. And the second one is income. These are the strategies like high dividend stocks and covered call strategies. It is designed for investors looking for steady cash flow. And third one is a core type. These are the building the blocks for any portfolio, the central components. And the final one is commodity. This includes things like gold and the companies that deal with these resources. And so these 4 categories together form a comprehensive suite that supports a variety of the portfolio objectives. So on this slide, you can see our top 10 ETFs by AUM, and the names highlighted in the orange are our Japan-focused ETFs. And as you can see, they are doing really well and continue to attract a lot of interest from investors. And now, slides 15 to 17 shows our complete ETF lineup. You'll find everything here from growth to income and core and a commodity. While we won't go through every single one, but this gives you a good idea of the wide range of options we offer. So let's now turn to the Japanese market outlook, starting with the policy environment. So since the Abe administration, Japan has maintained a consistent focus on growth and reform, and the corporate governance improvements have supported more stable earnings. As a result, the Nikkei 225 has continued to be trending higher. And now the Prime Minister Takaichi is in office, and we're seeing a lot of continuity. So her election gives the market a sense of long-term political stability. So it really feels like Japan is entering the new phase of much stronger economic momentum. And in the most recent lower house election in February, the LDP under Prime Minister Takaichi won a significant victory. And her high approval rate gave the party a lot of momentum during the campaign, and they secured clear majority in the lower house. And in the upper house, the ruling party did not have a majority, but the lower house can pass the bill with a second vote, even if the upper house rejects that. So this structure allows the administration to advance policy measures more smoothly than before the election. The central pillar of the administration's economic approach is what it calls a responsible proactive fiscal policy. So basically, the government has identified investment cap in key areas, and they are stepping in to fill it. So the goal here is really simple. It's to de-risk investment for private companies. And by taking the lead, the government is encouraging more capital spending and R&D to create a sustainable growth cycle. And we are already seeing the company's capex on the rise with ambitious target of the 130 trillion yen by 2030 and moving toward 200 trillion by 2040. And also on this chart, showing the foreign direct investment of Japan is still relatively low compared to the other G7 countries or Asian peers. It has actually grown 10 times over the last decades regarding Japan, but the Japanese government is really focused on using this framework to attract even more global capital and strengthen Japan's foundation for the future. And the government has picked 17 strategic sectors as top priorities for long-term growth. So these include advanced technology such as AI, semiconductors, quantum, and cybersecurities. So what's really important for business here is the government has set up the multi-year budgets. So this gives companies much better visibility so they can feel confident about making big long-term investment. So these sectors aren't just local peak and they align perfectly with the global trends like digital transformation, national securities, and the energy transition. So this list basically shows you that exactly where the future growth in Japan is going to be. And the logic behind the government's policy is really simple. So it's all about creating the virtual cycle. So public investment triggers private spending, and which leads to more business activity and better hiring and higher wages. And this in turn boosts consumption and keeps the growth going. So, and we're seeing the real evidence on the latest indicators on this slide. So, wage growth continue and is expected to remain solid this year too. And inflation has eased slightly below 2%, but remain positive. And GDP is expected to show modest growth from this year and onward. So after nearly 30 years of the deflation, it really looks like Japan is finally moving into much healthier economic cycle backed by these strong government policies. And this active fiscal spending often leads to concern about the debt sustainability. But actually, Japan's fiscal position is moving in the right direction. So the debt to GDP ratio has dropped from the about 258% in 2020 down to the around 230% in 2025. So the government strategy here isn't just about raising taxes, it's about growing the pie. So expanding the nominal GDP through targeted investment and higher productivity. So as the corporate earnings and the wages go up, the tax base naturally broadens. So this creates a much more stable and healthy fiscal foundation for the medium term, we think. Up to this point, we've just focused in on the policy. But now let's look at the market's actual performance. So if you look at the performance over the last 3 years and also the half year, Japanese equity have been incredibly stable and resilient. So whether you look at them in the yen or US dollar terms, Japan has really held its own compared to the other major markets. So this reflects steady earning growth and improved corporate governance and the growing confidence from global and domestic investors. So on top of that stable performance, valuation in Japan are still very appealing. So while many global markets have become quite expensive, Japan is still trading at the attractive levels, especially when you look at these about indicators. And even with the recent rally we've seen, the corporate profitability is still improving in Japan. So this suggests there is a plenty of room for further upside over the medium term. So when you combine this steady performance with such reasonable valuation, it really creates a great backdrop for long-term opportunities in the Japanese market. And next, let's look at Japan's improving supply-demand dynamics. So this is driven by the three structural factors. So first, corporate governance reforms. Companies are finally prioritizing the ROE and value creation, so which has pushed shareholder returns to record high. And second, we are seeing the unwind of close shareholdings. So as companies sell off these old stakes, they're using that cash to buy back their own shares. So in fact, you can see on this chart, Japanese corporates have now become the market's largest net buyers of their own equities. And finally, the NISA scheme. This is a tax-exempt program for individuals in Japan, and it is channeling a steady stream of long-term money from retail investors right into the market. So these together, this shift provide a very solid floor for stock prices and also to create a much healthier environment for investors. And now let's talk about the yen. So if you look at the top left chart, you can see the massive regime shift since 2022. So the yen broke out its long-term range of 105 to 115 and even peak above the 160. So when you look at the 30 years view below here, it's clear that we're now in the extremely weak zone by historical standard. And on the right side, we are comparing the US dollar against other major currencies. And you can see the yen, this orange line here. And this has seen the sharpest depreciation among these other currencies. So while some like Swiss franc have actually gained value, and the yen has moved to the opposite direction. So this is a reality, the currency environment we are now in. And now let's look at what the Bank of Japan is actually doing. So we're seeing a major shift from emergency defense to the normalization. So on today's meeting of BOJ, it held the rates at 0.75%. So they took a cautious pause because of the tensions in the Middle East and the rising oil prices. But this isn't a change in direction of them. So the BOJ is very firm, so they will keep raising rates as long as the economy stays on track. So the market gets this. And in fact, the current market survey shows that there is still a 60% chance uh, of the hike as early as April. So essentially, they're performing a delicate BOJ have to be performing a delicate balance act of with the managing short-term global risk while staying fully committed to their long-term path of rate hike. And so let's see the yield gap between Japanese yen and the US dollar as well. So the core message is here is simple. While we might see some short-term volatility from geopolitics or oil prices, the fundamental trend is shifting. The yield gap is narrowing and that favors a stronger yen for long term. So since 2022, the yen has been under a lot of pressure because the Fed was hiking and while Japan stayed loose. But that situation is completely reversing now. So the Fed is pivoting, toward cuts, and while the BOJ is normalizing. So taking a longer view, we expect that the gap would to go to the narrowing and the yen to move gradually toward a stronger position. And I want to address a common concern. So people often worry about when the stronger yen hurts Japanese stocks, but historically, that's not always true, as you can see on this chart. So with the strong earnings and the better corporate discipline we see today, we believe a steady yen recovery and a healthy stock market can absolutely coexist. And from this page, I wanted to go through the 4 key themes we will focus on today. So here, the AI and semiconductors, defense tech, and banking, and shareholder returns. And this chart showing the 1-year performance of indices linked to the each theme with the topics. And as you can see, the defense tech and the semiconductors have been the real standouts and delivering a very strong result. And our banking and shareholder returns themes have also consistently outperformed the broader market. And while the robotics and AI have lagged a bit recently, but we don't think this changes the long-term story. So in fact, we believe the AI-related theme remains incredibly attractive, and I will explain why in this next section. So our first theme is AI semiconductors. On this slide, you can see that our first innovation has reshaped society from the first industrial revolution to today's digital era. And we are now entering the fourth industrial revolution. So this is where AI, robotics, and other high technologies are all coming together to fundamentally change how industry work. So at the center of this transformation is AI. And AI has a major driver of global economic growth. By 2030, AI-related developments are expected to generate about 16 trillion US dollars in global GDP contribution, and it is underscoring the long-term scale of this trend. And AI continues to evolve from cognitive AI, generative AI, AI agents, and now physical AI. So physical AI refers to AI systems that can move, perceive, and act in the real world. So Japan, with its strong industrial robotics capability, Japan is particularly well positioned for this shift. So AI is also included in the Japanese government's 17 strategic priority sectors. So there is a very strong policy support backing this up. AI use cases continue to expand rapidly across finance, healthcare, and even defense. So because it's spread so fast and so wide, AI remains a very powerful long-term theme, we think. And for these reasons, we believe that companies and ETFs positioned to benefit from this shift really deserve close attention right now. And now let's look at the backbone of all of this. And AI-powered services, including social network, rely on the cloud computing and big data platforms. And semiconductors are the foundation of everything. And in fact, the pace at which AI can scale depends on the semiconductor performance and manufacturing capacity. So this is why AI and semiconductors must be viewed as tightly linked investment themes. And Japanese companies account for just 9% of global chip output, but they dominate the equipment, materials, and the components essential for the semiconductor production. So in many of these critical areas, Japan holds the top global market share. So as the world demands more AI, they have to use Japanese technology to build the infrastructure. Global demand for semiconductor manufacturing equipment remains strong as new factories are built worldwide. So this supports multi-year equipment upcycle, and Japanese manufacturers with their high market shares are structurally positioned to benefit as well. And as we see, Japan plays a crucial behind-the-scene role in the global chip ecosystem and so leadership in equipment, materials, and components. For investors already exposed to the US semiconductor names, adding Japanese semiconductor-related stocks can be broaden value chain coverage and provide complementary exposure to the same theme, we think. And our next theme is defense tech. So traditionally, we saw innovation move from the military to civilian use. But today it's the exactly opposite is happening. So civilian tech like AI, drones, and cybersecurity is now rapidly transforming to defense use. So this is a huge opportunity for Japan as the industry move away from just building big hardware toward a more technology-driven supply chain. So it aligns perfectly with Japan's deep expertise in advanced manufacturing and high-end components. And we're also seeing the global surge in defense R&D as national security becomes a top priority everywhere. So while the US is still the leader in the spending, Japan has accelerated its R&D spending incredibly fast in just the last few years. So what's important here is the stronger coordination between the government and the private sector, especially in dual use technologies that can be used for us both civilian and the defense purpose. And this commitment is backed by real numbers. So Japan's defense budgets jumped from the 6.8 trillion yen in 2023 to 8 trillion in the 2024. But for the companies and the investors, the most important part is the 43 trillion yen defense build-up program through 2027. So this provides long-term visibility. So companies can now plan and invest in the infrastructure and equipment because they know the budget is locked in for several years. So this is a massive tailwind for the entire supply chain. And then finally, you can see how this theme ties everything together. So many of the government's 17 priority sectors, like AI, semiconductors, space, aviation, and cybersecurities, are directly linked to defense. As civilian tech continue to integrate into the national security, we believe defense tech is still in its early stage. But with this level of policy support and the budget momentum, it is creating a very durable long-term opportunity across Japan's entire industrial base. And now let's turn to the banking. So this has been one of the most watched sectors in recent years, and after decades of near zero rate policy, we are finally seeing the structural turning point. So as long-term interest rates moving up, the banks are benefiting directly from expanding net interest margins. So this is exactly what being driven their massive outperformance against the topics and giving us much more clear earnings visibility than we've had in years. So compared to the US benchmarks, including US financials and bank and Nasdaq 100, Japan's bank has outperformed in both local currency and also the US dollar terms. So it also reflects their stronger balance sheet and much more disciplined approach to the capital efficiency. And at the heart of this sector are the three mega banks in Japan, MUFG, SMBC, and Mizuho. So these are the pillar of the Japanese banking system, and they've done a great job expanding their earnings from overseas, and now they're catching the tailwind of higher domestic rates. So they have also taken a more proactive stance on shareholder returns and raising dividends and conducting large-scale share buybacks. So our indexed comparison with the Topix Bank Index shows the mega banks are clearly leading the sector because because of their scale and diversified revenue, and we believe they remain the primary drivers for the entire banking scene. And our final theme is shareholder return. So one of the most unique thing about Japanese company is their massive cash reserves. So compared to the peers in the US or Europe, the Japanese companies are incredibly cash rich. So this is important because it gives them a huge amount of structural room to keep increasing dividends, conducting more share buybacks, so and still having a plenty left for long-term reinvestment. And we are already seeing this shift in action. So shareholder returns, both dividends and the buybacks, have surged recently. And for a long term, Japanese companies were criticized for sitting on too much cash. But thanks to governance reforms and Tokyo Stock Exchange initiatives, that's changing now. And companies are now much more focused on capital efficiency. So this isn't just a short-term trend, and it's become a permanent structural part of Japanese market. And the best part is there is still so much room to grow. So right now, Japan's payout ratio is the low of a 50% range, and compare that of the 70% or 80% levels we see in the US and Europe, and that gap is really clear. So as the profitability improves and the reforms continue, we expect this move toward higher return to accelerate. And it's a powerful long-term tailwind for the entire equity market. Essentially, Japan is becoming a much more investor-friendly place to put your capital. So to wrap up everything, Japan is clearly entering the new phase. And we have stable policy, proactive investment, and a real shift in the corporate behavior. So with rising wages and the stronger capex, the foundation for growth is more durable than we've seen in decades. So today we've focused on the four key themes on this slide: AI semiconductor, defense tech, banking, and shareholder return. So these aren't just temporary trends, and they're structural shift and that will shape the Japanese market for years to come. So thank you very much for your time today, and I hope this session will be the clear view of landscape and more importantly, where the real opportunities are emerging. So I'll now like to hand the session over to the Philip Nova team.
Thank you, thank you, Maki, for your insightful presentation. Now we'll hand over the time to Danish, our senior market analyst from Phillip Nova, who will be sharing about Japan market review so far, the AI value chain in Japan, as well as diving into Japanese banks and global leaders. Lastly, Danish will also be touching on how you can hedge FX volatility as a client of Phillip Nova. Over to you, Danish. Meanwhile, if you have any question, please feel free to type them in the chat box and we'll be addressing them together at the end of Danish presentation. Thank you.
Hi, hello everyone. Thanks for tuning in. Special thanks to Maki as well, who's actually conducted the seminar all the way from Japan. And I'd like to extend my thanks to people who are tuning in, as well as the physical attendees, because this session is actually a hybrid session as well. So before we proceed, just to introduce myself, I'm the analyst for Phillip Nova, and today the main theme in the market that I'll cover is the Japanese market. So just a short disclaimer before we proceed. This presentation, it's intended for general circulation as well as educational purposes only, and does not serve as financial advice because we do not take into account your specific financial resources, your financial situation, your financial needs, as well as your specific investment objectives. So this is a rough agenda of today's seminar. I think Maki previously shared a lot of wonderful things about the Japanese market. So I'll add a little bit more color to the Japanese market. Share with you guys on some of the very popular, very famous companies that can be potential investment opportunities as well. So let's begin. So just a quick review of the Japanese market, at least for 2026 so far. Year to date, it's about 6.5%, but the Nikkei actually saw a pretty bad month of March. Couple of reasons. Of course, we do have the Iran crisis. Something else which impacted the markets was the sell-off in some of the software companies. One main reason as well is because the investors were starting to get concerned that AI could displace or essentially put some of the companies' entire business models at risk. And I think we can see that a common theme is that what we call AI enablers, essentially companies that they provide the compute necessary to build AI models. I think a good analogy would be maybe you think of it as like a kitchen. The food that comes out of the kitchen could be your AI models. AI enablers essentially, they provide the tools that are located in the kitchen themselves. So AI enablers, companies like Furukawa have all outperformed, while like I mentioned, software companies who investors are concerned that their business models are at risk at AI have actually underperformed. So let's talk a little bit more about some of these companies. These are some of the best performers this year, and just narrowing it down to certain themes. Metals and mining companies like Mitsui, Kinzoku, Sumitomo Metal. Of course, they have benefited from higher copper and precious metal prices, and their business is really pretty export heavy as well. So they have benefited from the weaker yen. And something else is that these companies are seeing very strong demand from copper foils that is used quite heavily in some of these AI servers in the data centers as well. After that, we do have like optical fiber companies like Fujikura, Sumitomo Electric, Furukawa Electric, and they're benefiting because they're seeing more demand. Because what we're seeing in the data center space is what we call a data center scale out, where you do have essentially increase in scale of data centers. You do have multiple GPUs, and you do have to connect all these GPUs together into a rack, and you do have to connect all the racks with each other in a whole data center as well. And lastly, we do have specific companies in the whole semiconductor space. I'll share a little bit more color on this later on. We have companies like Disco, which I'll talk a little bit later, who they essentially make like wafer cutting, dicing, and grinding equipment. Companies like ROM, who makes chips which are more tailored towards EVs and automobiles. And lastly, we do have Resonec. They have a very dominant market share, mainly towards the back-end packaging processes once the chips are finished being manufactured. So a particular company as well, which I think is quite popular, is Kawasaki Heavy Industries. You guys may have, if you guys have ridden motorbikes before, their motorbikes are actually pretty popular. But that's not the only thing they do. Currently, they are seeing what investors are calling a triple tailwind. They do manufacture robots as well. And I think Maki has previously mentioned the defense sector in Japan, a very interesting and very, I would say, a sector that has a lot of opportunities moving forward. And not only that, they also operate in the renewable energy business. So you can see from this table which I provided, they operate in multiple segments. They do operate like aerospace systems, where essentially they sell like defense equipments, aircraft components, and planes themselves. A very large customer is actually the Japan's Ministry of Defense, and then you have like their renewable energy segment. So it's a very I would say a very huge company which is involved in multiple industries. And this Kawasaki is actually one of the best performing companies this year as well. So what about the underperformers? Like I mentioned, there's a lot of fears that AI could disrupt the business models of some companies. We have seen new LLMs being released, like Claude Cowork, who could potentially replace some of these very high cost consulting businesses and traditional software business. So these are some of the companies which have underperformed. Nomura Research, consulting company Bay Current, Shift Inc., which is a software testing services company as well. And then we do have Recruit Holdings as well, whose share price is really under pressure, mainly due to all these AI disruption fears as well. So these are just some of the themes to share on why companies underperformed or outperformed throughout this year. So now let's talk about, I'll add some color as well to the whole AI value chain, Japanese banks, global leaders as well. So maybe I'd like to start off, how to shed some color and just explain very briefly how this whole semiconductor industry works. So companies like NVIDIA, AMD, they don't actually manufacture their own chips. You can think of them as what they do is that essentially they'll send their designs to companies like TSMC and Samsung. They are what we call foundries. They are essentially factories which produce the chips themselves. However, like I mentioned, you can think of the foundries as like a kitchen. But to actually cook food in a kitchen, you still need extra tools. You need a stove, you need a refrigerator. So this is where we come to companies who provide the raw materials, the semiconductor tools. Companies like Tokyo Electron, Lasertech. And the thing is that Ms. Maki has shared just now as well. The Japanese semiconductor industry is actually very, I would say very strong in this area. The very, very first step of this whole value chain, they have a very dominant position in the global semiconductor manufacturing equipment industry. So, maybe you guys don't believe such a thing. There's actually an economic metric which is called the Herfindahl-Hirschman Index. Some of you maybe have studied finance, you may have heard of this before. It's essentially an index which measures market concentration. So of course there's formulas, they square the market share percentage. It's used by regulatory bodies like the DOJ and the FTC. So you look at this table over here, you can see that based on the HHI index, as long as it's above 2,500, it's believed that the industry will have very, very few competitors. You can see that it's essentially the majority of, sub-industries in the whole semiconductor equipment maker market. I'll talk a little bit about some of these, sub-industries like mask inspection, lithography, and coater or developer systems. So I think something to understand as well before we proceed, how does a chip actually get made? This is a very, very simplified version. So the first step, typically, we have to start with silicon dioxide or SEN, essentially. But, we do have Japanese companies like Sumco, Shin-Etsu, where what they do essentially they refine, they melt the sand that we have, and then it will essentially give you, a very big silicon crystal, and then the companies will have to slice it into, you may have seen before, it's like a very huge, CD, a very huge round CD. We call it a silicon wafer. So once it's out, you can't just build semiconductors from it. You do have to clean the entire silicon wafer itself. Something as a small dust can actually make the chips that's out being produced, they can render the chips useless. So it's very important to clean the wafer. The next step, which is probably some of the more important steps, is third step, which is the coating. This is where companies like Tokyo Electron, they will coat the silicon wafer with what we call a photoresist. It's a chemical that's sensitive to light. So it will react to light. And once the silicon wafer is coated with photoresist, then we come to a step which is called lithography. You guys may have heard of this. ASML, it's a company which is world famous for producing EUV machines. So I think a very simple way to think of it, you can just think of it as spray painting. How it works is that the EUV machine will essentially use light, and then there will be a photo mask, which is, you can think of it, they call it the stencil or the photo mask. You can think of it as maybe holding a pattern, with the circuit over there, and then they'll shine the light through that specific photo mask. So the light will essentially touch areas of the wafer which is coated with photoresist, and it will essentially imprint the circuit pattern. So of course, once the circuit pattern is imprinted, then we come to the fifth step, which is developing and etching. Developing, essentially, they use the chemical called developer. They'll wash away the photoresist, which will then reveal the circuit patterns onto the wafer. And then we come to etching, which is they craft the circuit pattern onto the wafer itself. They remove the unexposed areas of the silicon wafer because the circuit patterns they're not 2D, they're actually 3D as well. So these are done by companies like Tokyo Electron, LaserTech, and ASML. So the sixth step is deposition. You deposit new materials. This step is repeated about 100 times per chip. So whatever I mentioned up to now is actually repeated countless number of times. So the final two steps, second, once all this is done, you do have to inspect the chips themselves, because like I mentioned, something as small as a dust particle can actually make the entire chip useless. Once all this is done, you do have to test every chip. This is done by companies like Advantest, a Japanese company as well. And then you do have to cut and slice that huge wafer into individual chips as well. So this is a whole very, very simplified process. There's actually a lot more steps. For example, there's different types of deposition as well. This is a very basic overview of how it works and how different companies are involved in the whole process. So what are some of the key players in the whole industry? You probably have heard the name Tokyo Electron quite often. Like I mentioned, they are highly involved in etching, deposition, coating. Shin-Etsu, again, they have a very dominant position in the silicon wafer, the first step of the whole, how do you build a chip. All the way at the bottom, we do have Disco, a very, very high market share in the cutting, dicing, and grinding of silicon wafers as well. So now let's talk about market share. I've kept on repeating that they have very dominant market shares. Again, lithography. I think needless to say, most people who are invest frequently or quite in tune in the tech side of things will know that ASML essentially dominates the lithography market. They have about 95% market share. However, what I think is frequently underlooked is the coating developer etching market. And this is where Tokyo Electron has about a 92% market share. Roughly similar to ASML, but almost essentially the same dominant market leader position. So without sharing our specific stock views, I'll just share with you guys what some of these companies do. Like I mentioned, Tokyo Electron, they make equipment for etching deposition. Again, like I mentioned, there's different types of deposition. CVD, which is chemical vapor deposition, ALD, atomic layer deposition. So it's a more advanced, it's a very intricate and very highly complex, process. Some of their key clients, foundries like Samsung, TSMC, Intel, and like I mentioned, very strong market share of 92%. And they can be found in some of the Global X ETFs, which Miss Maki shared previously, the Global X Japan Semiconductor ETF, as well as the Global X Japan Tech Top 20 ETF. I'll share a little bit more on these two ETFs further on. And these are some slides from Tokyo Electron's company presentation, as well as earnings call. Like I mentioned, 92% market share, very strong, substantial market shares in the other, parts of the whole semiconductor manufacturing process, like cleaning, wafer bonding as well. So, I was thinking, why not let the company themselves, share about what their biggest strengths. Again, 100% market share for EUV. EUV is the key process when it comes to making highly advanced AI chips. So either way, as long as companies need AI chips, as long as the AI chip is produced, Tokyo Electron is very highly likely to be involved alongside ASML. Again, a lot of their major products are either number 1 or number 2 in terms of global market share. So they're a very strong company as well. Has a very dominant position in the global semiconductor value chain. Yep, so these are a lot of their different products, which ranges from deposition to testing, cleaning, etching, lithography. So some other sectors to share with you guys. We have pattern wafer inspection. So this is once the silicon wafer, once the pattern has been printed, you don't need to inspect it. But we do have the photo mask inspection. If you guys recall, the photo mask is essentially what is used during the whole EUV process. It's like spray painting, and then you have a pattern. It helps imprint the circuit pattern onto the silicon wafer itself. So Lasertec, really, I think they are right now the only company in the world that provides these inspection machines for EUV machines. And essentially has a monopoly in this area. And like Tokyo Electron, they can be found in the Global X Japan Semiconductor ETF, as well as the Tech Top 20 ETF. So, just to give you guys a little bit of better visual cue on how this whole ASML machines work, this is a picture of one of the machines. It's an EUV machine from ASML. You can see it's a huge, huge machine, probably the size of an entire room. So, maybe I would ask, if this was a fully physical seminar, I'll ask you guys how much it costs. But so a single machine, it can cost up to $450 million just for a single machine. Of course, there's a range. There's later versions, earlier versions as well. Typically, it's cost at least $300 million just for a single machine. And this is very, very key, important, I would say, machine that enables chips, very, very small chips as well for AI. Now, lastly, sharing the other sectors, we have the dicer and grinder, the testing sector as well, which is, essentially you test, once the chips are finished, you have to test it, test its performance, test its reliability. Again, the dominant companies, Disco, 75 to 80%, Advantest, about 59%. So to share some light, add some color to these companies, Advantest, again, they essentially make the machines that test these chips. Disco, they do cut, grind, and polish some of these wafers into smaller pieces as well. Again, the common theme, the common thread is that both have very, very strong market share in their respective markets. So I think this was shared by Ms. Maki previously as well. All the companies which I mentioned, they actually fall under the Japan's semiconductor equipment market. Again, we are seeing the revenue in the sector trend upwards ever since 2021. Of course, quarter by quarter, it does go up and down. It's a seasonal thing, but the overall trend is that it's going upwards. Why? Because, as AI demands more chips, this means that essentially demand for some of these equipments that allow you to make those chips will increase as well. So because of all this very, very strong, market position, market share, what we see is that these companies have very, very dominant, margins as well. So for this chart over here, the green line is NVIDIA. Again, they're probably the, I'm sure all of us have heard of NVIDIA before. In terms of margins, it's about 71%. But not very far behind, we have Disco, which is at 70% as well. You guys may be quite surprised that, there's actually a Japanese company with similar margins to NVIDIA. And then we have Advantest, LaserTech, which is 50 and 57% respectively, even higher than AMD as well as Apple. So I think this shows how dominant these specific companies are as well. And I think the last company I added, it's Pan Pacific PPIH. It's actually the parent company of Don Don Donki, which is very popular in Singapore as well. So this I hope this demonstrates to you and the audience as well of exactly how their strong market positions contribute to margins. Now, I think the next part, maybe you guys may be asking, or maybe thinking that these companies, they're so complex, and you guys may be a bit hesitant to actually put your money inside some of them. And of course, then comes the aspect of stock picking and things like this. But Global X, like I mentioned, they do have specific sector ETFs that track essentially all the companies which I mentioned and even more. We do have the semiconductor ETF. Again, they do have the highest weightings in Disco and Advantest, Tokyo Electron, LaserTech. So a very good, I think, tool for investors to gain exposure to semiconductors and not just a single company. And then we do have the Tech Top 20 ETF. Again, this it's not really a pure semiconductor exposure kind of ETFs. What they do is they do provide non-semiconductor exposure like Sony, Nintendo, Fanuc as well. Fanuc, again, a very interesting company. They're actually, I think, Japan's largest industrial automation manufacturer. And credits to Global X as well. They provided us with this data. You can see that in terms of global market share, so this across the entire world, we do have about 4 Japanese companies, which are among the top 5 largest industrial robotics manufacturers. Epson, Fanuc, Kawasaki, Yasakawa as well. And you can see over here that Fanuc is actually one of the constituents. So again, another very interesting industry, which is the Japanese robotics industry. So outside of this, I think the Japanese market, there's 5 core themes. Of course, automation robotics. We have companies like Fanuc, TDK, semiconductors, which are the companies which I mentioned, and something which is pretty, I would say, overlooked as well with the content and platform companies. Companies that develop home entertainment products, gaming consoles, and software. So this includes very, very popular companies that I'm sure you guys know, like Nintendo, Konami, for example. So again, our colleagues from Global X has shared with us very useful data. If you were to look at the Japan content market, these are the official statistics. This includes like film, TV, anime, publishing, and games. And you exclude all the non-official statistics like the music, anime, social media. Just look at the official statistics. The content market itself is almost of similar size to the steel and semiconductor market. So it's not a small market. I think some people, they may have a misconception that how big can the whole market of anime, games, TV, how big can it be? It's actually pretty big. And if you include all the other mediums, so like social media, VTube, content creators, the actual market size is estimated to be about 11.1 trillion, essentially almost double of the whole semiconductor industry. So now I think company I like to share some color with as well is Nintendo. They have launched the Switch 2. Currently it's priced about US dollars 450, their most expensive console of all time. As of their latest data, it's currently outpacing sales for the original Switch at about 17.3 million units. The company, I think, is targeting about 19 million. I believe it's very highly likely they'll hit that target as well. Other than this, in recent days, if you to look at, just take a look at Google, if you look at the share price, Nintendo has been actually performing really, really well. One reason is because of the recently released game called Pokemon Pokopia. It's released maybe about 2 weeks ago, exclusive on Switch 2. It's seeing extremely strong demand, about 2.2 million copies sold in just the first 4 days. And they have upcoming movie as well, the Super Mario Galaxy movie. And I think some people may ask, what's so big about the movie? So the reality is that it's actually very, very big, because historically what we see, like we saw in the previous Super Mario film as well, all the way back in 2023, it does contribute to higher sales for games as well as toys. And if you look at data just for the game alone, it actually boosted sales of the Mario Kart game by about 8.2 million units. And the key thing is that Nintendo owns essentially all the IP rights to Mario. So of course, other than this, outside of these fundamental aspects of the company, recently they were in the news because they were one of the few companies which actually sought out a refund for tariffs that they paid to the US government as well. But on the other hand, something that's actually, I would say, a negative aspect that the company is facing right now is rising memory costs. Some of the memory chips that we are seeing, like DRAM, NAND, flash chips as well, prices are rising rapidly because there's a memory crunch globally, and it's impacted some of these consumer electronics companies. So Nintendo is one of them that's been impacted as well. And I think for some of these video games, animation companies as well, the key thing is that they do own IPs. For example, Nintendo does own the IP rights to Pokemon. I believe it's actually about 33%. So not, they don't own entirety of Pokemon. We do have Hello Kitty as well. Sanrio, for example, owns the IP rights to Hello Kitty. Of course, Mario and Nintendo. And then we have Dragon Ball and Gundam. Bandai Namco, another company, owns the IP rights to these two media franchises as well. And this is very important because if they were to own the rights to some of these IPs, there's a lot of ways that they can monetize it. For example, just with Dragon Ball alone, you can monetize it through animation, through movies, through games, through maybe toys, for example. And like I mentioned, Global X, they do have an ETF which tracks essentially all these companies. Nintendo, again, is over here. Bandai Namco is over here as well. So this is, I would believe, a tool which is better suited for investors who want to gain a broad exposure to Japan's games and animation sector, which is a sector that you don't really hear very often, as well. And a good diversification away from US, from the tech side, from AI and things like this. So maybe I'll talk next about banks and global Japanese leaders. Again, I think it was shared by Maki previously. Banks, they are very likely. They tend and historically do benefit from higher interest rates. And as we all know, Japan is expected to raise their interest rates. Of course, they may not raise it immediately, but the trajectory is most likely higher interest rates as well. And the reality for banks is that, how do they make money is actually a very simple model. Uh, you know, essentially they make money by essentially charging you interest on loans, and then this interest that they receive from loans essentially should be higher than the interest that they pay on things like deposits. And this spread or this difference is what we call a net interest margin. And historically, higher interest rates tends to increase the net interest margins. You can see from this chart over here as well. We do have the three biggest Japanese banks, MUFG, Mizuho, Sumitomo Mitsui. You can see that there's a very clear trajectory, probably from 2024, middle of 2024, the net interest income that some of these companies have is on their very strong uptrend. And you can see from the dotted lines us here as well, they're projected to continue, net interest income is expected to continue increasing and trending upwards. So, in case you guys want to have broader exposure to the banking sector, there is a Japan Bank High Dividend ETF as well. Again, majority of the weightage is centered around the three major banks. Of course, there are other financial companies, Japan Post Bank, for example, but the theme is similar. Banks, they are very likely to benefit from higher interest rates. Lastly, I think the last company I'll talk about is fast retailing. I think this essentially it's the parent company of Uniqlo. I'm sure all of us who live in Singapore probably wore a Uniqlo outfit before. Okay, the reason it's called, it's actually called fast retailing is because they actually run multiple other businesses. They do have a sister brand called GU. If you've been to Japan, I believe you guys may have actually seen the store called GU as well. The growth rate for GU is actually faster than their main Uniqlo business. And yes, this is a company that has a very recognizable name on the global stage as well. So let's say you want to invest in the global leaders in Japan. Global X also has a very attractive ETF, which holds essentially all the world-renowned, world-famous companies like Toyota, Sony, Nintendo, fast retailing. And these are companies essentially with very high global market share. So now I'll come to the last section of the seminar. I think some of our clients' main concern is FX volatility, especially because right now we are seeing the USD JPY hitting about approaching 160 or higher. So I think it's a legitimate concern as well. This is actually force what we call currency translation risk, and I think to put it very simply, if the yen gets weaker, as a Singaporean investor, what ends up happening is that essentially if the yen gets weaker, this means that when we convert it back to SGD, we'll get less SGD in return, which means our Singapore SGD denominated returns will be lesser. I think this chart shows it quite well. In terms of JPY, the semiconductor ETF over the past 1 year is close to 80%. Converted back to SGD, it's about 61%. So both are still very strong. But of course, FX volatility is a legitimate concern. But it works both ways. A stronger yen will essentially mean that your SGD returns are higher. So for some of our clients, I think what we think is a good strategy will be to essentially hedge or mitigate FX risk with a long SGD JPY, either futures or spot. So this works very simply. Step one, you do have a long equity exposure. It could be any of the Global X Japan ETFs which I shared with you previously, and then to essentially hedge out yen volatility, yen weakness, what you do is that you buy SGD, you sell JPY. So if JPY depreciates, your FX leg or your FX hedge will gain, and this will offset some of the FX volatility as well. And then, of course, when it comes to hedging, you do need to make sure your sizing is correct, because you do need to match your notional exposure with your hedge exposure as well. So I do have certain numbers to demonstrate clearer. So imagine that you hold the Global X Japan ETF. First thing you need to do is determine your SGD exposure. So let's say that you hold about 50,000 yen worth of Global X Japan ETFs, and assuming that the SGD JPY rate is about 100, this means that your Sing dollar exposure is about 500. So what you want to do is to go long on SGD JPY. You buy SGD, you sell JPY. Again, there's different kinds of hedge as well. You have a full hedge, where essentially you fully hedge your ETF position. You sell a full amount of 50,000 yen. On the other hand, depending on your risk appetite, you have a partial hedge where, for example, if it's a 50% hedge, you sell 25,000 yen. And to put it very simply, the end result that you'll get is that if the JPY weakens, we'll see that this, your FX leg, SGD JPY will rise, and this gain in your FX leg will somewhat offset the negative impact of FX volatility. So let me proceed with an example. I think this flashes it out a lot better. Again, ETF position, 50,000 yen worth of Global X ETFs, assuming a rate of a starting FX rate of SGD JPY of 100, assuming that you fully hedge your position and that the ETF stays flat, means it doesn't move. The ETF value starts at 50,000 and it stays flat. You can see from this table, let's say the SGD JPY rate, it goes from 100 into 110. When you convert it back to SGD, you'll see that your ETF value actually drops to about 454. But again, if you were to hedge it with your FX leg, you'll see that this gain in your FX leg somewhat offsets the loss in terms of currency translation as well. So what this whole hedge does is that it essentially just removes the currency volatility, removes currency fluctuation, and you are essentially limiting your exposure just purely to equity risk, which is the ETF value. You can see that the end result, even if the SGD JPY weakens all the way to 120, that your net SGD value for the ETF will remain at 500 Sing dollars. Of course, this is a hypothetical scenario. Your ETF stays flat, but of course we know that in reality, your ETF doesn't stay flat. So let's move on to a scenario where both your ETF moves as well as the yen. And to be transparent as well, when you hedge out with this FX leg, what you're actually hedging out is only the currency risk, not your equity risk as well. You're still exposed to your ETF fluctuations, ETF movements as well. So we have 4 different scenarios over here. The area where I want you guys to focus on will be the end results. The furthermost, the rightmost column will be your P&L. If you were to, just hold a long position, you don't have any hedge, or you don't hedge your position with FX futures or spot. On the other hand, this other column is your final P&L if you were to pair it with a hedged position. So the very first scenario, let's say your Global X Japan ETF does well, goes up by 20%, and the SGD JPY currency pair weakens to about 110. If you were to do the math, what you'll see is that it's the best case scenario. You gain you profit from your FX leg as well as your equity leg as well. On the other hand, the worst case scenario will be if the ETF does poorly and the yen strengthens. In this case, your ETF, of course, it will drop in terms of value, and you will suffer a loss as well on your FX position. Of course, this loss can be limited if you were to do like a partial hedge. If you don't hedge the full amount of as well. So I think with that, I've come to an end of my seminar. And thank you guys for listening. If you do have any questions, do feel free to type in the chat, and our host will proceed with the Q&A. Yep. So Billy, back to you.
Thank you, Danish, for your presentation. All right, thank you, Danish, for your presentation. Now we actually have some questions in our inbox, and the first one is from Ho In Chan, and this attendee actually say that they invested in Japan through an American listed Japanese ETF. And Ho In said that I agree that with the new administration's expansionary fiscal policy and the detachment from its lost decade years, the Japanese equity market will grow over the long run. However, what are some risks in investing in the Japanese semiconductor industry and the Japanese market in general, especially with high AI capex and growing AI fears? For this, I'll open the floor to both Maki and Danish to answer.
So maybe I'll take the question first. So I think like I mentioned previously, there's of course risks. AI capex and growing AI fears, they are relevant in the US market, but definitely also relevant in the Japanese equity market. In terms of the risk, again, the same thing that you mentioned, but I think part of the reason why you should invest in the semiconductor industry of Japan is that some of the companies which I shared, they do have very dominant market shares. They are, to put it, pretty simply, is that they are essentially Nvidias of their own respective industries in the respective segments. Of course, stocks, equities, they are prone to market fluctuations, ups and downs of the markets. But generally, if you were to stay invested, this segment of the equity market is an area with the, I would say, best risk reward. Risk wise, it's very low because most of these companies very dominant market shares, but the reward side of investing in the semiconductor market, I would say, is probably one of the highest in terms of the Japanese equity market. Yep. So maybe Maki, do you have anything to add?
I'm okay with your answers. Thank you so much.
All right, thanks, Danish, for your answer. Now let's move on to the next question. You have a question from Han Leong, and Han Leong said that he saw recent announcement of Japanese banks with some stock price adjustments because of private credit. Can you comment on this? For this, Maki, would you like to take the question?
Sorry, could you repeat the question?
All right, sure. So we have an attendee that say that he saw recent announcement of Japanese banks with some stock price adjustments because of private credit. And this attendee asked for a comment on this.
Based on our research and the news base, we do not catch on that news. So I will check on the our research team, and then I will give it back to you after the seminar.
Thanks, Maki. Now we have another question regarding Global Edge Japan ETF. The attendee asks, do Global Edge ETF pay dividends and are they accumulated? What is the withholding tax rate and are capital gain tax free for Singapore investors? Maybe you can take the second part of the question. For the first part, can I have your comment on the dividends part, Maki?
So it's not. I'm not sure actually, but between the Japan and the Singapore, there is a tax treaty, and in Japan we had a 10% of the tax on the dividends, and then the other half is for the Singapore.
And also to answer your question, EG, for Singaporean investors, withholding tax of 15.315 is applicable for dividend distribution. And I believe for the dividends on Global X ETF, it depends on the respective ETF, and there'll be ETF that pay more dividends. But Maki, are you able to comment on whether the dividends are distributed usually? I believe they are, right?
I think your opinion is right, and then nothing to add from our side.
Thank you. Then, all right. Perhaps we can move on to the last question if there isn't any other question. The last question would be, given how Japan might be new to young investors or investors in general, how can they get started if they wish to invest in Japan? And I think maybe it was not really mentioned in our presentation earlier, but some Japanese stickers can get really expensive. Going for like, fast retailing is about $40,000 Singapore dollars per lot. So yes, how can new investors or just investors who are new to Japan get started in the market?
So as Billy mentioned, individual stocks are sometimes expensive for investors. So I really recommend ETFs because they can bought at a really minimum amount, and also they're just much easier to trade and then give you instant diversification. So I looked at the seems like we recommended like semiconductors or shareholder returns. Those were the big growth areas right now, and also it's also fun to start with things the like games or animation ETFs. If you're a beginner, just picking an ETF that focusing on the global leaders will be the great way to build a solid foundation, I think.
Thanks, Maki. That's very right, and I believe that many of Global Edge Japan ETF can actually be traded or like invested from, a lot size of just one share. So that could be a great option for you who are thinking to start investing in Japan. Now we have answered all our questions, and if you have any other questions, please feel free to reach out to us via emails. I will move on to do a closing for this seminar, and I'll take this opportunity to introduce to you quickly, who Phillip Nova is. We are more than just the organizer of this webinar, but Phillip Nova, we're actually a multi-asset brokerage. Okay, just before I begin, a quick disclaimer. This presentation is not intended to be a financial advisory, and while there are tickers that I mentioned, in this segment, it does not take into account the specific investment objective, financial situation, or particular needs of any particular person here. All right. So Phillip Nova, we were previously known as Phillip Futures. However, in about 5 years ago, we introduced stock or equities into our product range and rebranded into Phillip Nova. So currently, Phillip Nova is a multi-asset brokerage, and we offer the trading of stocks, CFDs, forex, futures, and commodities. And yes, we do have several platforms, but in this opportunity, I would like to introduce to you the Nova platform, where you can actually trade all the asset classes that I mentioned earlier on a single platform. And at Phillip Nova, Nova platform, there's also no custodian and platform fee, and this platform is available on mobile, iPad, and desktop. We also have charting powered by TradingView, and we also offer direct connectivity with TradingView. And yes, I also would like to introduce to you some of Global X ETF and who Global X Japan is. So just now we had listened to the presentation by Global X Japan, specifically by Maki Kudo. And yes, Global X itself is known for its thematic growth ETF, as you can see on, the left side of the screen here. So with Global X ETF, you have access to various thematic growth ETF that includes some of the tickers that were mentioned earlier, Global X Japan, robotics and AI ETF, games and animation, semiconductor, and fintech. Beyond this thematic growth ETF, Global X ETF also offer you some other product types, including the core Japanese ETF that track the largest companies, the global leaders, the S&P 500 index, as well as certain commodities including uranium, Japanese metal businesses, and gold ETF. Global X Japan also offers several type of income ETF. This includes ETF that typically have higher dividend yield, including J-rate ETF as well as the bond ETF. And at Nova platform, we offer equities trading to 6 markets currently. These include China A Stock Connect, Hong Kong, Japan, Malaysia, Singapore, and United States. And for Japan market trading, specifically through the Tokyo Stock Exchange, our commission is charged as 0.1% with a minimum of only Japanese yen 380 per order. With that, I would like to introduce to you this exclusive event that we are going to have next week. Looking closer, rethinking Singapore equities, that will be held physically at Peacock Event Hall at 7 p.m. next Wednesday. This is an exclusive invitation for all of you here today. You may scan the QR code on the right and indicate your attendance. Please also feel free to bring a friend along, and there'll be extra perks for those who are bringing their friends. Lastly, thank you for joining us today, and you may follow our Telegram channel for more updates. Thank you so much, everyone. Have a good evening.
Thank you.